Hi, everyone. Thanks for joining. We are just going to wait a couple minutes for everyone to join on so that we can talk about tax loss harvesting. Hope everyone's having a good week. Feel free to use the chat at the bottom here. Let us know where you are. We're up here in Seattle, and Andrew is in Chicago. You can use that to ask questions throughout the webinar as well. Andrew, in crypto and in the NFL, the Bears are getting killed, man.
Yeah, that's for sure. But I feel like that's always, well, not at least with respect to crypto. I was going to say it seems to be always the case when we're talking. You always have to rub it in.
Well, I mean, it's not the 1980s.
That it is not. That is not. But sometime again soon.
One day it'll be the 80s again.
Yeah. It took 100 years, so hopefully won't.
Ryan Selkis had mentioned something. He's like, I don't want to see Bitcoin at 1 million because it means that the United States has become a failed state and our currency is garbage now. And I replied to him, hey, the price of gold in 1920 was $20.67. The price of gold today is $1,850. That's an 87x increase in 100 years. If you take the price of Bitcoin today, 18.5, and you 87x it, you get about 1.6 million. So
yeah, it's possible.
The Bears will be good again sometime in that span.
Yeah.
Great. We have international guests as well. We have people from Israel and the great nation of Texas. Okay, so let's see here. So hi, everyone. We're just waiting a couple minutes to let everyone continue to join the webinar here. We'll be talking about tax loss harvesting, and we can answer any of your other questions as well, whether it be about getting things tidy for the end of the year, good tax strategies, how to respond to IRS warning letters that are increasingly coming out, and just any other general thoughts, like is the IRS going to care about auditing? No price predictions, no warnings against shilling coins. That's not what we're in the business of. If you want to ask our thoughts on other news like Visa or PayPal, we'll give you our uninformed opinions. Cool. I think we're safe to start here. Let's see here. So I'll share my screen. Cool. So hi, everybody. This is the webinar with Gordon Law Group and ZenLedger to tell you about what you need to know about crypto tax loss harvesting. So before we start, we're recording this. You can request a recording, and I'll just email it out to the attendees. And you will have contact information for Andrew Gordon and his accounting and law firm at the end, as well as for ZenLedger, and we have a coupon for you for year-end for our services. My name is Pat Larson. I'm the CEO and co-founder of ZenLedger. I used to be a Navy helicopter pilot, got my MBA at U Chicago, and worked in finance and tech. Founded ZenLedger about 3 years ago. We've worked with over 10,000 customers at this point. We've worked with hundreds of tax professionals, probably thousands actually, including big four accounting firms, ultra high net worth practice. And we work with a lot of exchanges, wallets, DeFi projects, all of that. And the thing we really hang our hat on is customer service. I hope you always feel comfortable jumping in chat, email, or phone with us. And it's very tough. It's a very tough process to get all your transactions and taxes cleared away, but you can always get a hold of us, and we really hang our hat on that. And one of our partners, and who we work hand in hand with, is Andrew Gordon.
Yeah, well, thanks, Pat, for the introduction. My name, again, is Andrew Gordon. I'm an attorney, and I'm also a CPA. Before law school, I actually got a master's in accounting and went the CPA route. But my practice is mainly focused on tax controversies. And so within that, for actually several years, we've been working in the crypto space. So we're not new into the space. We've actually been involved since late 2013, early 2014. And we help with everything from preparing crypto reconciliations, including using ZenLedger, to preparing full tax returns, IRS audits, crypto and otherwise, to responding to IRS warning letters. You name it, if it's crypto and tax related, we likely have seen it.
Great. And then Andrew, feel free to.
Sure. So the disclaimer, the fun part. So we're going to be talking about a lot of different tax, accounting, and legal principles. But this video, this webinar is not tax, legal, or accounting advice. It's only for informational purposes. You shouldn't rely on anything that we talk about today to replace tax, legal, or accounting advice. You should always consult your own advisor before engaging in any transaction. And I think that just about does it.
So what we'll talk about today, tax loss harvesting, how it helps you save on taxes, IRS rules and requirements regarding tax loss harvesting, crypto tax loss harvesting tools from ZenLedger, the coupons we have, and then just any Q&A. So what is tax loss harvesting? So it is the selling of securities at a loss to offset capital gains, tax liability, and this strategy is typically employed to limit the recognition of short-term gains. And what that means is you're trying to optimize your taxes, right? You have gains, but you have a portfolio of assets, so you have some losses, or the assets are very volatile. Bitcoin has gone from 6,000 to 3,000 to 20,000 to 16,000 to 19,000. There's plenty of places in there where you could have sold at a loss and bought back in and had some gains, and they're going to offset each other. We've had customers who have found tens of thousands of dollars of losses that offset their gains. We've actually had customers who have found $230,000 of overstated gains over the course of 4 years of filings, and they went and got refunds on that. So since crypto is treated as property under IRS rules, that means the same capital gains rules apply. We'll get into a little bit more of the gray area there with what the wash rule is as well. And so why would you benefit from this? Because Bitcoin's volatile. The smaller coins with smaller market caps, even more volatile. So there's places to get in and out. You could have bought into a DeFi token right at the top and then sold it off. December, there's typically some taking of gains from traders. And so you'll see some dips in December as well going into the end of the year. So you can benefit from that, not just so far, because there's been a fantastic run up. Everyone probably has a good amount of profits, but you may have losses from previous years that have gone unclaimed that you'll want to claim. But then also toward the end of this year, you'll want to look at your full portfolio and think about what assets you want to sell that are currently trading at a loss, and maybe just buy them right back on January 1st of next year, or sell them at a loss now to buy into an asset in December that you think will appreciate. Say you think Bitcoin's going to outperform Ethereum the rest of the year, you may want to shift some in there, and you want to sell the Ethereum that you may have purchased at a higher price. You could have purchased Ethereum at 1,200 and haven't sold any of it yet. You could sell it today and have a 600 of loss for each Ethereum you sell. It's totally possible. So Andrew, would you like to talk about the legal requirements here for tax loss harvesting?
Yeah. So overall, a lot of people are very critical about the tax environment, especially with respect to cryptocurrency. But in our view, the tax loss rules with respect to crypto is actually beneficial, or the lack of explicit guidance with respect to crypto tax loss harvesting is beneficial. And we'll talk a little bit more about the wash style rule and what's involved in that. But in general, there isn't a whole lot of guidance overall about crypto from the IRS. There is some. There's been a lot of things that have been defined, but what hasn't been defined specifically is, well, what do you need to do in order to have the benefits of tax loss harvesting for crypto? And so generally, we look to all the same other legal requirements that apply to property, since crypto has been defined as property. And so overall, you can sell your crypto to realize losses. And as Pat mentioned, in order to actually harvest a loss, you have to realize it. You have to sell the crypto. And so your losses from crypto can be used to offset gains that are in the same crypto. They could be gains in other crypto, or they could even be gains in other capital assets, such as stocks or securities. So for instance, maybe you have gains in stocks, and then you could sell crypto at a loss, and you can use those crypto losses to even offset your stock market gains. So crypto losses and crypto gains aren't the only things that could be netted together. It can be all property that's reported on Schedule D of your tax return. In addition, if your losses during the year exceed all your gains, you can take up to $3,000 of losses and apply that to your ordinary income. So typically your W-2 income, for instance, you could reduce up to 3,000. Anything over that that still remains as a loss can be carried forward to future years. And that's also really important to note too, because losses can be carried forward, but they can't be carried back. So a lot of people have hoped, hey, can I use these losses to reduce prior year tax gains? Not for capital assets, unfortunately, but they can be carried forward. So if in 2021 you start to incur a bunch of gains, you can use these losses from 2020 to offset those 2021 gains. Finally, we're in the beginning of December. We're at an all-time high. And although it may seem like this topic is less relevant because Bitcoin is so high, we still have a lot of time before the end of the year, and a lot of things can happen. But also, as Pat mentioned, you may be holding several different coins, maybe even holding a shit coin from years prior that you've just been sitting on. Well, maybe it's time to finally sell it and realize that loss, but you have to do it before December 31st. You can't come to ZenLedger, come to me on January 15th and say, hey, I wish I sold it last year. It's just too late. It has to be done before December 31st in order for it to be counted in the 2020 tax year.
So wash rule.
All right, so wash rule. So the wash sale rule was originally constructed to apply to stocks and securities. So when people were trading stocks, for instance, they used to try to do the same thing that we just talked about for crypto, where if at the end of the year they would sell their stock, realize that loss, but then often people don't want to actually just lose that stock or exit that position. They want to buy it back. And so the wash sale rule was issued by the IRS and basically said that if you sell a stock or a security at a loss and then buy it back within 30 days, we're not going to give you credit for that initial loss. It's a wash. And so if this applied to crypto, this would be very negative. What it would mean is you can't sell, for instance, crypto today and then buy it back on January 1st because it would be less than 30 days. Although you could do it, you wouldn't be able to record the loss in 2020. But because of the way the IRS wrote their guidance, it specifically refers to stocks or securities. And as I mentioned a few minutes ago, there's a lot of areas of law that people are very critical on, but this is one that we can really use to our advantage as crypto traders, because the current law only applies to stocks or securities. And so by our interpretation of that and many other practitioners, cryptocurrency that is not a security doesn't apply. And so Bitcoin, Ethereum, many of the other cryptos that are characterized as utilities should not, at least under current guidance, current interpretation, fall under the wash sale rule. And so what does this mean? It means you can sell for instance, your Ethereum that you bought at $1,000. You could sell it today and realize that loss, but then you can buy it back. How long do you have to wait? Do you have to wait till the next year? You don't necessarily have to wait that long. As a best practice, and if you want to be very conservative, wait 30 days and do it in the next tax year. But there is the potential to buy it back in short and then buy so quickly that really nothing has occurred. It needs to be risk that the price has fluctuated. And so as long as you allow some time to pass, generally in the order of days, that should be sufficient to satisfy this rule.
Yeah, except on the end of an accounting fiscal accounting year. So you can sell it a minute before midnight, December 31st, buy it right back the minute after midnight, January 1st, and you'll have claimed. So say I bought Bitcoin at 20,000 on the minute before midnight, December 31st. It's trading at 19,000. I can sell my one Bitcoin for 19,000 on December 31st. I can wait 1 minute, boom, midnight, January 1st. Happy New Year. I can buy back that Bitcoin at 19,000 because the price would not have moved much. And now I would still own my one Bitcoin at 19,000. And now I would have a negative $1,000 loss. And that's a tax loss asset that I can apply to my gains in 2020 or my income tax in 2020. So that's the core of what we're talking about for tax loss harvesting. But you could have sold an asset December 15th, buy it back January 1st, or you can sell an asset, when you want to. But that's kind of like when people want to buy something back, they still love the asset. It just happens to be trading at a loss. They still want that asset. Then this is how you can kind of maximize your tax optimization there. Okay. So our tax tool looks like this. You just go into your reports in ZenLedger. You'll see your multiple years of reports. You'll click on View Reports, and then we'll output a tax loss harvesting output for you. We'll just send it to you, and you can look through it, and you can pick the accounting method that you are using. And so I can walk you through this live here. And what we'll do, down here you can select exactly which accounting method you want: first in, first out, last in, first out. First in, first out is the most conservative and the one that's generally recommended. And we'll list in summary view every loss you have, and we'll prioritize it, biggest loss first. And then if you go from FIFO to a detailed FIFO, you can just kind of see how to read it. So I know that I have 70 or 102 NEO that I could sell right now, and I would capture a loss of $500. If I sell more than 102 NEO, I start getting into the NEO that's profitable. Over here it's green, so it's telling me, oh, okay, NEO, I have 102 I can sell. And then if I sell 103, that one extra NEO will actually trade at a small profit, and I'll have a couple dollars of profit there. It'll eat into the tax loss that I want to capture. Don't want to do that. So this analysis was run just now, and these are the current market prices. So you'll want to run your reports right before you start doing your tax loss harvesting, so you know exactly for right now, today's market price to the second, what you're looking at. XMR here. I know that I can sell through a couple different price points here. So we're kind of updating. We looked in your past. We saw when you bought XMR, what the price was it when you acquired it, the cost basis. And we were saying today's price, here's what you can do. You can sell 41.04 XMR, and you will have a $7,000 tax loss asset that you'll gain. But don't sell any more, because then you'll start getting into your gains. So that's how you read this, and we can always answer your questions in chat or email once you dive into it a little bit more. But it's really simple. You'll just go into the app, click on View Reports over here, and then come over to Tax Loss Harvesting right here, and then you'll click on this to get your guide, and then you'll have your guide here. Pick the tab for the accounting method you've chosen to use, generally FIFO. And then just go through looking for red, and you'll know how much you can sell to capture tax loss asset. So pretty simple, pretty straightforward there. But if you have questions, you can always ask. And then just for general contact information here, we have our coupon, tax loss 15. So you can use this anytime before December 15th. And then the tax analysis will be there for you. So you'll be able to use it through December 31st, which is the last day you can tax loss harvest. But then you'll have, if you buy a 2020 tax year plan, that means you're filing April 15th or October 15th, 2021. you'll have full access to your tax loss harvesting for right now. So that's what you would want to do. If you want to analyze your current losses, you have to purchase the 2020 tax year reports from us. And you can contact us here at zenledger.io. Hello at ZenLedger. There's always a chat icon in the bottom right of our app right here. It's this little smiley envelope thing. Just click on that and you can start chatting with someone. We work all weekends, evenings. We're always there for you. And then one thing we do is we work with Andrew's firm. Here's their contact information right here. And you can buy fully prepared reports from them. So if you don't want to do any of this, or you need just more sophisticated help because you have a 401k and LLC, you have different assets, and you have different legal issues that you need opinions on as well, or you need a CPA that understands crypto as well as traditional assets, then Andrew's group is the way to go. And you can purchase plans through at zenledger.io, where you'll gain access to all our software and then also be able to work with Andrew's team. Okay, I think we've covered most of these, but let's jump into some of these questions here. One is basically, how do you claim lost crypto? How do you claim it if you no longer have access to it? If you can't find a market to purchase it anymore? Those are two separate questions. So Andrew, do you want to answer like how to claim lost?
Yeah, so it's a good question, and unfortunately, it really depends on the facts because, as Pat was just mentioning, there could be different situations. For example, you could transfer crypto to an exchange that disappeared or closed down, or perhaps it got hacked, or maybe you sent crypto to someone and then it was a scam, which is more akin to a theft. Or maybe it's just an ICO that you bought and now it's basically worth pennies. So depending on the situation, there's different outcomes. But for example, if it was a scam, if it occurred in 2018 or before, then you could take a deduction for a theft loss. After 2018, that the theft loss deduction was removed, but there is an argument that you could often take that the security is now, that it's could be considered a worthless security or under the same guidance as worthless securities and treated as if it was sold for zero. And so there's all different treatments that can apply. The more aggressive is that it's treated as sold for zero, which results in a capital loss for whatever your basis, but it depends on the type of transaction, the year that occurred, and really all of the facts. So feel free to reach out to us and we can always talk through your situation.
Yeah. So there's an important question here about your holding period, short and long-term capital gains. So a quick example here is, let's see here, we'll just say January 1, 2018, bought 6 ETH at $1,000. November 1, 2020, bought 4 ETH at, let's call it 500. Today, price ETH is 600, right? So in this case, you will have, if you go in and you look at it, you will have 6 ETH that you could sell at a loss of $400 per coin, or $2,400 total of tax loss that you can harvest. You won't incur a short or long-term capital gain because there's no gain there. There's only loss. You don't have to concern yourself with the holding period of the tokens you sell at a loss. So that's important. The gains, if you have gains, you do have to consider if you've been holding the coin for less than a year or more than a year. If you've been holding it for less than a year, you'll generally have a higher tax rate of short-term capital gain. It depends on your income level, but that's something to consider. So when you're selling gains, consider short versus long-term capital gains. When you're selling losses, holding period doesn't matter. But you'd not want to sell, if you sold all 10 of your ETH, you would have a $2,400 loss here to claim because 6 times 400, 2,400 loss. If you then sold these 4 ETH that you acquired at 500 and have a $100 gain on each, you have a gain of $400. So if you sold all your ETH, your 10 ETH total, you would actually end up with a $2,000 total loss. So that's the 2,400 loss, minus the $400 gain, would be a $2,000 loss in total if you sold all of it. So that's why you don't want to do that. Why you might not want to do it. If you thought you want to sell all your ETH, buy Bitcoin with it, or some altcoin that you think is going to go up like crazy in the next month, then you are just kind of freeing up cash. You are not maximizing your tax loss harvesting, but you are maximizing the cash you have available to buy an asset that you want to appreciate. So it's not, there's a lot of factors to consider. You can also offset $3,000 of income. So if you have $3,000 of capital losses or $10 million of capital losses this year, you can apply 3,000 of it to your income next year, and every year going forward, you draw a little bit down. So another thing to consider: if you sold a house for $10 million this year and you had $10 million of so if you had $10 million gain from selling your house and then $10 million loss from selling your crypto, those would also offset. Is that correct, Andrew?
Yep, correct.
Okay. So if you're great in real estate and terrible in crypto, they're offsets. And other way around, if you had a bunch of commercial real estate maybe, and it went south, but your Bitcoin's been going great, those can offset each other as well. But not legal or accounting advice there. Okay, Andrew, are there Roth IRA? Can you do tax loss harvesting inside?
Roth IRAs, you're not getting taxed on your distributions. You're not getting taxed on your income. So really, there's no reason to do it. I don't see any advantage or really any benefit. So I wouldn't necessarily bother with doing it, because even if you realize greater losses, there's no gains that you're going to be taxed on anyways. So generally not something that's that has a benefit for a Roth IRA.
If there's no longer liquidity in a coin, there's no active markets, like, do you just write it down to zero?
So I would first try to sell it, right? And often, there's some liquidity, but if there's absolutely none, then you could treat it as basically worthless and sold for zero. As a best practice, I would probably transfer it to just a separate wallet so that you could show that it's separately held and thereafter never moved again. But if we're going to write it down to zero, then in the future, you can't move it and decide you want to sell it or do something with it. That's it. Once it's written down and sold as zero, if you then do want to record it again, that's generally taxed as ordinary income to you, which is a much less favorable result.
Yeah. So no one wants to buy Mitch Trubisky rookie cards, so just write it off, but then give it to a kid. Don't try to sell it on eBay after you write it down to zero.
Yeah,
because
exactly.
no one wants to buy it anyway.
Right. Right. No one actually wants to buy it, then you can't in the future.
Okay. So there are no better years to claim cryptocurrency losses. You have to consider this next month, right? So in the year of 2020, you can have losses and gains, and then next year when you're filing in April or October, you're reporting October 2020. This all happened in the past. The thing you have to think about right now is the future is December 2020. That's the time you have to act. You could sell crypto today to harvest tax losses. You can sell it up to midnight, December 31st. But those are the cutoffs. So right now is the time to act. You could have sold crypto at a loss January 1st, 2020, and claim it, October 15th, 2021. That's totally fine. But what we're talking about is right now, what can you do? How are you going to actively manage your crypto holdings and your buys and sells to maximize cash and maximize and optimize your tax portfolio? So that's the concept we're going after here. I do believe we've talked about illiquidity and things being locked up and things being lost. So I think we've covered all of that. If you already have a $3,000 loss in the stock market, and then you also have crypto losses, it just kind of tacks on. All your capital losses tack on. Your real estate, your crypto, and your stocks. and they'll just all add up together. So if you have 3,000 of losses in each of those areas, you'll have 9,000 of losses total for the year. 3,000 of those losses can be used in 2021 to offset your 2020 income taxes, and then you'll have 6,000 of a tax loss asset that you carry forward. But if you have more than 6,000 in gains in that year, it wipes out the tax loss carry forward. Okay. Andrew, you want to talk about international
Yeah, sure.
finance?
Yeah, so it's a question that comes up a lot is if I'm using a foreign exchange, Binance International, or pick whatever, Bitfinex, BitMEX, pick your foreign exchange of choice. If you're using a foreign exchange, but you're a U.S. person, so U.S. citizen, U.S. resident, even a U.S. citizen living abroad, you are still taxed on your worldwide earnings, and you have to report all of your exchange activity. So all exchanges, even the international exchanges. And so what I also am referring to is even the international exchanges that you're using a VPN, they're using potentially a fake name, whatever the circumstances may be that you're obtaining access on that foreign exchange. To put it bluntly, the IRS doesn't care. That's not the IRS's issue with you. What the IRS wants to know is that you report all your trading activity and that you pay the required taxes. So all foreign exchanges, all online gambling sites, all of those types of things, all of your activity needs to be reported on your US tax return. It's taxed just the same way as if it was Binance US or Binance International. Doesn't matter which exchange the transactions. Bitcoin is Bitcoin. It doesn't matter where it occurs. The transactions are all taxed and recorded the same way. But it is important to report everything. We've had several clients come to us that before they came to us, they reported only Coinbase on their tax returns. And then the IRS audited them for crypto and was very quick to identify that Coinbase wasn't their only exchange. And it became a much bigger issue than if it was just all reported from the beginning.
Yeah. So Francis, I hope we answered your question about tax losses can offset long-term and short-term capital gains. They absolutely can. You're closing out a trade today, but say you've been holding Ethereum for some of it for 5 years. So you might have to, the problem is if you've been a long-term hold and you bought a bunch of Ethereum at $1, then it'll be very hard for you to get to the point where you have gains. I guess it all depends on the amount. So if you bought one Ethereum at $1 and you have $600 profit from 5 years ago, but then you also bought one Ethereum at 1,200 and 2 years ago, and you're selling it all today, you're selling your 2 Ethereum, it'll kind of offset each other, right? Because you'll have 600 in gains and 600 in losses. And then it won't matter that you had a long-term gain and kind of a long-term loss. It'll match up.
Yeah, just quickly to add to that, because I think that's a really good point. Tax loss harvesting doesn't make sense for everyone. It makes sense for a lot of people, okay? But especially if you plan to get right back into that same token because you're long on it, because you think it's going to actually appreciate, you need to keep in mind that by selling and buying back, yes, you're realizing a loss, but you're resetting your holding period. And so like Pat said, in some situations that may not matter, but if all of a sudden then the price skyrockets and then you want to sell, well, maybe now you're in a short-term gain position. Whereas if you didn't realize that loss before and then buy back, you would have been in a long-term gain position where generally the tax rates are about half. So tax loss harvesting is a great strategy. It works for a lot of coins and for a lot of people, but you also need to just consider your own investing strategy and whether or not it makes sense for you.
And there's also different levels of conservatism or aggressiveness in how your accounting method. So if you're using a highest in, first out, and you're maximizing the amount of losses you have, you could have $10 million of gains because you bought a bunch of Ethereum very early on, but you have $500 of losses you want to claim by selling one Ethereum today. and you don't want to count all the Ethereum you bought at $1. You want to count the Ethereum you bought at 600 and it's now selling at 500 within the last week, right? So that is an aggressive take. It is not using the first in, first out accounting method, which is the most conservative and recommended one, but it's a choice that you and your tax professional would make.
Yep.
Okay, so I think several altcoins on Binance, can't move them. Again, you can write them off if you can't move them, if you've shown that you've taken the effort to try to get possession of them. If they're kind of known as altcoins that are kind of dead or dead projects, then you can kind of write them off to zero. Okay, I think that's all the questions we have. So again, just to remind everyone that you can visit Gordon Law Group at this website, and you can find them on Twitter as well, and email glg@gordonlawltd.com. Full service accounting and law group there that we work with hand in hand. They use ZenLedger for their clients. You can visit us at zenledger.io. Email us hello at ZenLedger. You can always chat with us by going to the bottom right and clicking on the little green smiling envelope inside our app. Here's a discount coupon, TaxLoss 15. You can use before December 15th to do your tax loss harvesting. You'll need to buy the 2020 tax year, and then you'll be able to use the tax loss harvesting output. You'll have to put it in all your transactions. You'll have to include all your exchanges, all your wallets, get it all clean and current, and then your tax loss harvesting report will be accurate. If you don't include some of your wallets, if you don't include some of your exchanges, then the analysis will not be accurate. And this works for this coupon will honor also for the full service packages. So those cost more. They cost $750 or a couple $1,000s, and what you're buying is full access to our software, and then also the tax preparation services and advice from Gordon Law Group. But we'll honor that 15% code as well for those. And you just go to our website, click on pricing, and you'll see all the packages. So I think with that, I think we're all set. Thank you everyone for attending. Thank you for your questions. Thank you for attending from Israel and everywhere else. We really appreciate it. We hope you're having a great holiday season and have a bunch of gains in your portfolio through end of the year. But if you have any questions, you have our contact information. Please feel free to reach out.
Thank you very much, Pat.
Thanks, everyone. Bye.